Hello and good morning. Welcome to Opportunities Abound in one of the world's cheapest stock markets, a 1-hour programme brought to you by Citywire and Fidelity International. My name is Gavin Lumsden, I'm from Citywire, and with my colleague Michelle McGarr, we'll be presenting today's broadcast. Today, we're joined by our guest speaker, Alex Wright, Fund Manager of Fidelity Special Values Investment Trust. Special Values has been one of the strongest performing UK equity funds in the rebound from last year's coronavirus crash. So it's encouraging to see from the title of his presentation that Alex remains confident of more gains to come. I'm looking forward to hear how Alex, a contrarian value investor who has managed the trust for 9 years, is positioning the portfolio after the impressive rally. Of course, the recovery raises lots of questions. After his presentation, I'm going to ask Alex a few questions and then it's over to you for Q&A. If you have a question for Alex about the trust or investing in the UK, you can submit it at any time via the chat box to the right of this screen. Michelle will monitor your questions and help me put them to Alex in the last section of our show. At the end, we'd be grateful if you could complete our short feedback form, which can also be found in the microsite you're viewing us through now. Okay, it's time to meet Alex. Alex, very good morning. Very good to see you.
Morning, Gavin.
That's a lovely
Good to be
view.
here.
Thank you. That's a very lovely view of St Paul's behind you.
Yeah, so it's great. We're lucky to be positioned in our office right next to St Paul's. As you can see, actually, it's a lovely day today. So I popped up to one of the meeting rooms upstairs to present this from.
Fantastic. Well, we've got a good crowd of investors waiting to hear from you. So in your own time, please make a start.
Great. So I'm hoping to speak for about sort of 15, 20 minutes before we go to Q&A. And we're just going to flip through a short presentation here talking about why I'm still excited about the opportunities that are here in the UK today. So if we just move through just the disclaimer on the first page and then on to slide 3. This just outlines the equity team in the UK. And the reason we like to start with this because it really shows the strength in depth that we've got in the UK equity team and also the length of experience. So I've just completed I'm just moving into 20 years at Fidelity now. Jonathan's also been here 15 years, my co-fund manager on the strategies. And then we have a broader UK equity team with similarly long experience on other UK funds. And then very importantly, particularly through the pandemic in the last year and a half, is the fact we've got 155 people covering equities globally in the analyst team, and they are extremely helpful at doing the due diligence and helping me with the company spreadsheets and meetings, etc., to really get the new stock ideas and monitor the stock ideas in the fund. And I think it's that breadth of research, really strong analytical skills of that team that really helped me on the strategy. Slide 4 then just looks at what the strategy's done over the 9 years that I've run it. And I'm pleased to say that it's not just been the last year that we've seen exceptionally strong performance, but over this 9-year period as a whole, we have been able to, in share price terms, produce an over 250% return or about 200% in NAV terms. And that compares to the UK market producing about a 90% return. And also, as we'll talk about, the value part of the market, which is the part of the market we primarily invest in, up only 50%. So it has been a tough period for value investors, but the stock-specific stories that we've been able to unearth within that universe has allowed very strong outperformance. And then in a year like you have just seen where value actually outperformed, you can sort of see if those factors and the stock specifics go with you, the potential for performance from the fund. And I still think there's a lot more to go for, both within the fund itself, but also in the UK market, which has been a global laggard. So if we go on to the next slide, this talks about sort of how does the UK market look compared to other global stock markets. And you can see here on the left-hand side, the valuation of the UK market compared to the US or the Eurozone. So historically, the UK market traded at a 10 to 20% discount to the US. But over the last 5 years, that's consistently opened up so that we're now at close to a 50% discount to the US market. And then if you just look at the Eurozone, this is a market that the UK has more in common with in terms of its makeup. And generally, the UK market traded roughly in line with that market. But again, there's been a big opening up over the last 3 years in particular to about a 25% discount. And if you see what that looks like in terms of comparison to the valuations of those major markets on the right-hand side, you can see of major markets globally, the UK is one of the cheapest, only really Italy and Korea being cheaper. And then if you look at the 10-year ranges of those markets, so where those markets traded in valuation terms over that period, you can see that almost all of the markets are more expensive than they've been at any point during the last 10 years, whereas that's very much not true for the UK market. Actually, it's really at the bottom of that blue bar. So in terms of one of the cheapest levels in absolute terms for the UK market. So that gets me very excited from a valuation point of view. But what's also important is what's happening to the earnings or the profits of companies in the market. I think particularly in the COVID recovery, that's somewhere the UK is also particularly shone. So if you look at the last page, the next page, sorry, you can see what's happening to earnings, what happened in the crisis. So the UK was particularly badly hit by the COVID crisis, but the rebound in earnings has been stronger than any of these other markets. So UK earnings rebounding circa 50% this year compared to more like only 25% in the US and 35% in Europe. So yes, the UK was badly hit, but we've also bounced back very strongly. So actually the valuation, while the UK market has marginally outperformed actually the US over the last 12 months, actually it's continued to get cheaper versus all of those markets because it's been the earnings that have really powered that outperformance. And that hasn't gone unnoticed, particularly by acquirers. So the next slide sort of just outlines some of the takeover activity we've seen just in special values over the last 12 months. And there's been more of this in the market as a whole. Obviously, most obviously at the weekend, we saw the Morrison saga come to a conclusion with the auction there. But these are bids right across the market cap spectrum and across different types of companies, be it house builders, gambling companies, infrastructure investors, healthcare companies, and defence. So I think across very broad swathes of the UK market, there's very cheap companies that are undervalued compared to particularly their US peers. And that's one reason we're seeing this large amount of takeover interest, particularly from private equity and also US-based corporates. So if we go on to talk a little bit about how the fund's positioned and what we're doing, that's the next section of the presentation. So slide 8 just compares special values compared to the market and also the largest open-ended funds. So we're looking here at the OICs in the UK market in terms of the biggest market caps. And I think what's interesting is quite how differentiated the way we invest is versus how most people are investing in the market. So the FTSE All-Share on this Morningstar style box is a reasonably value-y market, so just between core and core value, whereas actually most of the funds in the UK are investing in a core or a more growthy way. So you can see the average fund there to the right of the market in terms of its growth characteristics, and then the largest AUM funds actually all slightly to the right of that, or far to the right of that, in terms of being growth investors. So as a contrarian, looking at other things that people aren't looking at, that's particularly interesting for me, because actually this part of the market that I invest in has really become incredibly unpopular and less people are looking at it. And that's really outlined on page 9 in terms of what's happened to the AUM, so the amount of money invested in funds available in the UK on slide 9. That shows, if you look at sort of how much of the money in the investment companies universe is invested in UK funds, that's fallen for over 10 years from 11.2% to only 6.6% of investors' capital. So again, overall, a massive growth in equity markets over this period, but that's mainly been outside of the UK with actual net divestment of UK assets. And then if you zero down to look at value funds, these were already a small subset of the available funds in the UK in 2011, about 2.3% of total invested assets. That's fallen to sub 1%. So being a value investor was always sort of quite contrarian and quite unusual, but I'd say now it's incredibly unusual. So I think this fund is incredibly differentiated from actually where the vast bulk of investors' money are today. And that makes it, to me, quite an exciting proposition, because I think the ability to find alpha is much tougher if you're looking in the same part of the market that everyone else is looking. That the stories are well known, the valuations reflect fundamentals, but if you look in a part of the market where people really aren't hunting, that's where I think the exciting opportunities for alpha are. And so that's one of the reasons I'm so bullish today, not just on the UK market, but particularly the value part of the UK market. If we then zero into what we're doing in the fund and how the fund's performed recently and why it's performed how it is, that's on slide 10. So you can see here the performance of the fund since the start of the pandemic. So it was an incredibly tough year for investors in the fund last fiscal year to the end of August 2020, because we had a very big drawdown in the share price and the NAV of the fund through the first part of the COVID pandemic, where we underperformed the market, but also underperformed the value part of the market as well, which I was surprised at. And I think that it's not that unusual in retrospect for these periods of panic, that effectively sort of the baby gets thrown out with the bathwater. So even stocks in the fund that had relatively limited effect from the virus, like a Contour Global or a Serco or a DCC or a CRH, they also traded off heavily in February and March 2020. What we were able to do, though, is increase the gearing in the fund and actually increase our ownership of some of those names. And as more sanity came back into the market, we started to outperform that value index from April. We then did quite a few changes into the fund, as we spent a lot of time talking to companies about what was actually going on through the pandemic, and the fact that the UK consumer was unusually strong, had very high savings built up, and was looking to spend those. So we bought a number of more consumer orientated and UK economy orientated names. And those started to really work from the autumn of last year. So very strong performances from the likes of Inchcape, Halfords, Mighty, Vistry. And so actually, if you look at the period as a whole, you can see from the bottom that the fund outperformed the value index by 43%. So an exceptional period of outperformance, which was really teed up by that period of pain that we took at the beginning. And so obviously overall, the cumulative effect of that is a very positive result through the 2 years combined. So I think that shows the benefits of having this closed-end fund, where you always have confidence to back your winners if they go to lower valuations, and where you can use these periods of pain to really set up future performance. So clearly in a value contrarian strategy, you're going to see volatile performance. So it's important to stick with this fund over the investment time frame rather than being a short-term investor. But I think it shows that the benefits of doing that you can have overall a volatile but a very healthy outperformance of the market. We then go on to the next slide. That just picks out sort of the top 10 contributors and detractors over the last year. So you can sort of see some of those consumer names that we added to, Halfords, LSL, Reddy, Northgate, really powering performance. Some of the financial names as well, bouncing back. AIB was a stock we added to last April. And then some of the takeovers in the fund. So Megit, and also Spire, the failed takeover there, highlighting the value in that group. In terms of the top 10 detractors, it's actually primarily more defensive companies that haven't given up absolute value, but haven't increased in value in a rising market. So even companies that have had pretty strong pandemics and earnings that were continued to grow through the pandemic, like Serco, DCC, Contour Global, Phoenix, and Sanofi, those all saw earnings growth in 2020 and in 2021, but have underperformed. So we're happy to stick with those names that are defensive. So we do have a good cyclical exposure, but also a number of defensive stocks, so that the fund is broadly diversified with about 120 names in total. 12 then just has a look at the gearing of the trust. So again, reflecting the fact I think there's a lot of opportunities. You can see here that sort of through 2020, we increased the gearing of the trust, hitting a peak of about 20% in October last year. And we've maintained a reasonably high gearing actually since then. And so as we stand today, we're about 18% geared. So as the market's traded off a bit in the last couple of weeks, we've ticked that gearing back up again, taking advantage of some of the opportunities. 13 then has a look at the sectors we're invested in. So particularly some of the more GDP sensitive sectors, so the consumer facing sectors, the house builders, that's been an area that we've added to over the last 12 months, and generally use some of the defensive performers to fund that. So the likes of John Lang that was taken over, Roche that was a big position, we've trimmed down to fund those purchases. We continue to be underweight resources. That's about a 5% underweight. We do have a decent exposure to oil, but we're very underweight metals and mining, because I think that's an area that it's difficult to see value in, and actually are going to see falling earnings next year rather than rising earnings, which is quite different from most of the market. Top 10 holdings on slide 14 just shows the biggest names we're invested in. So I'm still very excited about the life insurers, which have performed well through COVID and very much backed up the thesis that we had that these were more resilient companies than people were giving them credit for. Legal & General, Phoenix in particular, continue to pay very strong dividends through the crisis. Aviva, while they did pause their dividend, have latterly got back on track and really slimmed the business down. And so those are the top two holdings. Shell is a big weight. I much prefer those to BP in oil because of the quite differentiated corporate strategy. And then some of those consumer names, Inchcape, Halfords, and then Mighty, which is more of a business to the business play, a key beneficiary of reopening, given that they clean offices, provide security, etc. 15 then has a look at the sector weights. So we've largely covered this in terms of the insurance being the biggest overweight, specialty retail being next, with metals and mining being underweight. Also, capital markets is an expensive sector that we're out of. Also underweight staples, because I feel even though that's an area that's been underperforming in general, that's still full of quite expensive stocks. So again, finding better opportunities elsewhere. 16 then outlines where we invest in terms of the market cap, and this is much more of a structural position. So Special Values is very mid and small cap biased, and we've got about 120 names in the portfolio, right down to some of these sub £200 million names. And that's the key differential as well, Special Values versus Special Situations, the open-ended fund that I run, that being closed-end, being smaller AUM, Special Values has the ability to invest right down to some of these micro caps where we've got higher exposure there than in Special Situations. Finally, then, to just look at valuations of the trust, I think this is a key reason why I remain very excited, is that even after the strong run we've seen it for the UK market and for the trust over the last year, the PE of the market remains low versus history at 12.3. And actually the PE of the fund is a decent 10% discount to that. And then based on these Fidelity estimates, we think there's much stronger operating profit growth from the fund over particularly 22 and 23 than you see for the market as a whole. So you've got a fund that is cheaper than the market, has slightly less debt than the market, producing a similar return on equity, so similar quality company, but at a discount and growing faster. So to me, that looks quite an attractive setup from here, both on an absolute basis. So I think things are absolutely cheap, but also particularly on a relative basis versus other equity markets, which are very expensive. Just to conclude then, I think slide 18 sort of sums up sort of what we're seeing. So I do think some of the big things that have been affecting the UK market over the last 5 years, so particularly the Brexit referendum and then the risk of a no deal or cliff edge Brexit deal, that has gone. We've got a deal. Everyone knows the setup. Clearly, it's not perfect, and you sort of see headlines, obviously, about some of the problems that that's caused. But the real big risk of there just being no deal has gone away. And then the UK, while being initially very badly hit by COVID, has very much been on the front foot with the vaccination program, opening up much more quickly than other parts of the world, and with that very strong recovery in earnings compared to other markets. So I think the very two big headwinds that we still had in 2020 have gone away, but yet UK equities continue to be really undervalued, that particularly in the value part of the market. So the value versus growth, those stocks are still at very differential ratings compared to history. Growth stocks are very expensive, but value stocks are very cheap. And that's a very unusual set of circumstances, which is producing a lot of opportunities. And that's why the trust gearing is high compared to historic levels at about 18% borrowed, because we do see a lot of opportunity today, not just from good valuations, but also from good earnings coming through, particularly in some of these UK domestically focused names where we have a strong overweight. And so I think, yeah, overall, the value in this portfolio is good from from an absolute and relative basis. And I continue to be quite positive about further upside potential from here.
Okay, thanks, Alex. That's a very interesting presentation. Just to remind our audience, to remind you out there that please send in your questions. Alex is highlighting lots of opportunities, so hopefully you'll have lots of questions too. But Alex, if I just can start the questions here. We're in October, a traditionally volatile month. The UK stock market may be cheap, as you say, but inflation, China, the high level of US stock markets is worrying some investors. You're still bullish, and you've got the trust highly geared at around 18%. What would you say to people who are thinking, yeah, I can see the long-term potential you're talking about, but I'm a bit worried about short-term volatility?
Well, I think I'll probably go back to the sort of right at the start and look at how the trusts performed over time. And I think being a value contrarian investor, you've got to expect volatility, and you've got to expect volatility in the market. So I think investors need to be not to be scared of volatility. That creates opportunity. Actually, the worst markets for me have been times where there hasn't been any volatility. So effectively just a continuation of a previous trend. That means it's difficult to pick up new ideas because the fund is looking for changes, looking for mispricings. So you want a degree of volatility in markets to be able to take advantage of that. Obviously, the important thing, though, when you see markets trading off, is not to panic and not to sell out at that point, because then you lock in losses. So I think the idea you should be thinking about investing in this on a 5-year plus time horizon. That's very much how me and the board assess performance. How are the rolling 5-year numbers looking? And certainly the idea is to substantially outperform the market on a rolling 5-year basis. And that's something we very much have achieved, and I think we can continue to achieve. Obviously, calling the market on a short-term 1-3 month basis is very difficult, and I would advise people to try and resist trying to do that because it's very difficult to call.
Okay, good advice there, thanks. We've got used to seeing the UK trade at a discount to the US, but against the Eurozone and the way you highlighted, that does look remarkable. But I think people want to ask, is the UK cheap for a reason, Alex? With the FTSE dominated by old world businesses and sectors facing the long-term consequences of Brexit and of course, the disruption of COVID.
Yeah, so I think, again, slide 5 is a really good one to focus on, because I think it is fair to say that the makeup of the US market is quite different from the makeup of the UK market in terms of technology and the big sort of FANGMA stocks being a large percentage of the market cap there. And that's a reason why, if you look at the sort of the blue bar in the right-hand side, that has consistently been above where the UK is traded. So the US market has traded more expensively. The UK market used to be at sort of a 20% discount. And I think that is warranted due to the differences in the quality of some of those companies and the long-term growth prospects of particularly the larger companies in the US. I think what's interesting, though, is that clearly the US has moved well out of his historical norms in terms of valuation to the upside now. And even like for like companies in the UK compared to the US trade at very differential valuations. And what's interesting is, yes, the UK market, clearly you could sort of say that there are the effects of Brexit, but as well, I think the big risks, those have been overhanging for the last 5 years. So consumers holding back, firms not investing, that damage has already been done rather than damage to be done going forward. And also, only 25% of the UK stock market actually is against companies domestically in the UK. So I do think that is the best opportunity today, but we still only have about 40% of the fund invested there. So actually 60% is invested globally in terms of stocks which play into the same trends as the companies quoted in the Eurozone or quoted in the US. So I think it's wrong to sort of just think of the UK stock market as the UK economy, because you get so much more. Actually, it's a quarter domestic UK, 3/4 outside. And I think sort of slide 28 is a really good one from the appendix to sort of highlight that, is two domestic UK companies that actually look almost identical to their US peers in terms of a UK house builder versus a US house builder. We know that the housing market's been very strong in the UK. A lot of people talk about that being one-off boosted by the stamp duty holiday, and that's going to come off now that that's finished. But I think that's the totally wrong way of looking at it when you have a global perspective, because if you look at what our US analysts who are based in Toronto are saying, they're seeing exactly the same trends in the US, and indeed the same in Canada, the same in Australia, the same in New Zealand. So developed markets globally, because of the low level of interest rates, the high level of savings built up through COVID, and also particularly the fact that people have spent more time in their homes than they've ever done in the rest of their lives over the last 18 months, has really made people reassess what they want from their housing. And generally that means they want a bigger house with more space. And so transactions and prices are up globally. That was very quickly reflected in the US. As you can see, Lennar and Vistry both trading off very quickly on the uncertainty as lockdowns came in March 2020. But come April, those trends were recognised, and Lennar is up over 80% since the start of 2020. Whereas Vistry, a stock that we purchased in the summer of last year, along with Redrow, another UK house builder we purchased, that was still down 60% from the start of 2020 when we purchased it. Yes, the stock has now more than doubled, but still not to where we were at the start of 2020. And earnings are quite a bit higher than they were at the start of 2020 now. So actually that stock is done well, but it's actually got cheaper over this 2-year period, despite a very like-for-like stock with very similar projections in the US having close to sort of doubled. So I think that's the real disparity that excites me about the difference between the UK and the US, is that actually similar stocks with similar fundamentals are just much more cheaply valued here than they are in the US. So again, we have two more examples here. Best Buy and Dixon's, very similar business models and trends, strong outperformance of Best Buy. And then Inchcape is a real case in point, because Inchcape is quoted in the UK, but only has about 5% of its business here. It's actually, its biggest markets are Australia, Hong Kong, Singapore, and Ethiopia. So it's a global motor distributor, whereas CarMax is a US-based motor distributor. Again, CarMax bounced back very strongly as demand and margins have been very strong, whereas at the time of purchase, again, in the summer of last year, Inchcape was still down 40%. Now, it has caught up some of that performance and is now trading above where it was in 2020. But again, that's because the earnings have come through. The company is actually on a lower valuation in terms of its 22 valuation than it was at the start of 2020, and still lags the US peer by about 20%, despite it being very much an international, not a UK business.
Okay, those are really striking anomalies. You mentioned Fidelity's analyst, and I was just thinking in terms of the forecast rapid profit growth for the portfolio this year and next. How accurate are Fidelity's forecasts?
Yeah, so obviously it's difficult for me to tell you that until things actually come through. But I would say certainly on an aggregate level, there's not going to be a massive differential between Fidelity's forecast for future earnings growth than there is for the market as a whole. So where we're showing the expectation of a very strong 65% market EPS growth, that's very close to consensus for 2021. Obviously, three quarters of 2021 is already gone. So the accuracy of that forecast, I'd say at this point is pretty good. Obviously, the further you move out, the accuracy of these forecasts will obviously decline. But again, the fact that we're seeing operating profit growth flat and then actually falling in 23 for the market, I think is also largely reflected in the market-wide forecast, not just Fidelity forecasts. And that's particularly because we've seen obviously a massive increase in oil prices this year that we forecast over time to come off. So we expect a long-term price of oil probably around $60, not 80. And so that obviously has a big effect on the oil sector, which is about 8% of the benchmark. And then particularly, and this is a big reason for the differential performance of my earnings growth compared to the fund, is metals prices have been extremely strong this year, particularly iron ore that went up to over $200 a ton, which we thought was totally unsustainable. So that's already come off to about $100 a ton, and we forecast it to be more in the $60 to $80 per ton going forward. So the mining part of the market, which has become a very large part of the UK market, materials over 12% of the benchmark, and that has really quite negative earnings through 22 and 23. And that's one of the key reasons we're underweight that sector. There's no long-term shortage of iron ore. Indeed, a lot of that is offline at the moment because of COVID-related or regulatory-related reasons in Brazil, and that will come back on over time. And China is the key user of iron ore and uses an extremely large amount per head as they've really industrialized the economy over the last 15 to 20 years. And as they shift much more to an environmentally more friendly and more consumption-based economy, that's going to be negative for the amount of metal used. So actually the demand supply outlook in iron ore looks particularly problematic over the next 5 years. So what are very high returns today, we think are going to fall off over time. So that's where one of our sort of key underweights is in the trust.
Okay, and that's why one of the slides showed that you had avoided or didn't hold Glencore and Anglo American. That's clear why now.
Yeah.
Looking at the portfolio and thinking of the environment, you're an investor who likes to go against the crowd. At the moment, the crowd is very much running towards stocks with high environmental, social, and governance scores. How do you incorporate ESG into your stock selection?
Yeah, so clearly both investors, but then also regulators and politicians have really ramped up sort of how important particularly environmental and social issues are for companies over the last 3 or 4 years. Governance has always been incredibly important to me as an investor and something we spent a lot of time on at Fidelity, but we've increasingly spent more time on those E&S risks over the last 24 months. And particularly, we've come up with the fundamental analysts, so those 155 equity analysts, also in conjunction with their fixed income counterparts as well, have come up with ESG ratings for all of the major stocks in the fund. And so that's particularly helpful because it gives us our own in-house view of where those risks are, rather than just relying on external rating agencies, because those external rating agencies are very backward looking and very data driven, and sort of, I would say, sort of have a sort of box ticking mentality. So actually some companies appear incredibly good from an ESG point of view, even though when you think about actually sort of what they're doing, that they don't actually score particularly well in terms of risks. So I'd say a good example there is CRH, which by MSCI is AAA rated, whereas we have a lower score than that internally because they have a very high carbon footprint. So they're a cement and aggregates business primarily. And the reason for the AAA rating is MSCI is all rated relative to other cement companies. So actually they score pretty well versus cement because they're only actually about 50% cement and have other lower carbon initiatives. And then also they do use a lot more recycled material because they're much more in mature Western markets where the price of carbon is high compared to some Chinese producers, which all use virgin coal. But ultimately, when you think about the absolute rating, they still have a very high carbon footprint and they are going to see higher carbon costs going forward. And that is something that could affect the costs for that business, which may be difficult to pass on to their consumers. And so that's one of the reasons that company traded up to high valuations last year, as people got very excited about the infrastructure plan in the US. Given that that was very much in the price and the valuation, and we had those worries, that differentiated internal rating sort of was one of the reasons why we were keen to sell out and find better ideas.
Okay. That's very interesting. Sticking with the ESG theme, I mean, tobacco. What's your view on tobacco stocks? Because they're often challenged on health, on the health impact they have on smokers. Imperial Brands was a 3.7% top 10 position last November, but it's not in your top 10 now. Is that because you're less defensive now, or do you have doubts about the company, its ability to move into next generation smokeless products, for example?
Yeah, so again, it's another interesting area because again, both the tobacco companies score very well on external ESG ratings because they have very good disclosure, and they have very good employment policies, and they have a very low footprint in terms of sort of cost to produce because the margins of the company is so high. Now, obviously, on an absolute basis, you've got to stand back and say, obviously, this is a product that ultimately does kill people, so it's not a good product, and therefore obviously there's going to be continued taxation of the product and a desire for volumes to fall over time. And indeed that is what these companies are doing. So I do think the glide path is positive because clearly these companies that are seeing volumes decline annually at a sort of 4 to 5%, putting up prices 6 to 7%, encouraging people to give up smoking, but at the same time making more profit out of those that continue to do so. And then obviously the companies are also looking to move their existing consumers to reduced harm products. So I think there is a long-term transition here, which could be quite positive for the industry in that people could still get the same enjoyment that they get out of smoking, but in a much, much lower risk way. Not a zero risk way, but a much lower risk way than today. And that could result in a much higher rating for the sector. So that's something that sort of excites me about. It's a very lowly valued sector because people view it as a bad product, which it is, and a product that's going to die over time. Like it certainly will. Like hopefully within my lifetime, we'll see certainly in mature markets, this product go away. But they can make a lot of money in the meantime, and if they really can transition their products, we can see a much higher rating, and also because the taxation is quite different, potentially a higher profit as well. So that's an interesting industry thesis. Imperial is then the cheapest of all the companies, so it's on about 6 times earnings with a 9% dividend yield, also with a strong balance sheet, much stronger than BAT. So that's why we invested here. Strongest balance sheet, lowest valuation. The big issue is that I think while the transition to next generation products, it's still unknown exactly what people are going to want to use in terms of vaping versus heat not burn, modern oral. There's a lot of different products people could use. My thoughts were that this company has time to transition, and again, as a fast follower business, as again the CEO comes from previous time at Bacardi that really wasn't an industry leader, very much a fast follower in spirits. You can really copy anything that works. The reason I've cut back the position is that it does look like the IQOS product from Philip Morris is taking off in Europe more quickly than I thought it would 12 months ago. And that is a risk because Imperial are only today just developing their heat not burn product, only testing it in 2 markets. They have a good vaping product, but it looks actually like heat not burn is the product that consumers are currently preferring, and Imperial are a laggard there. So I think it's still very much an exciting potential, but the risk is higher than I thought it was, because if Philip Morris really get an entrenched position in Imperial's big tobacco markets, that will be negative for the profit in those markets quicker than I thought it would be. And so we need to manage the position size, and we've cut back to about a 2% position size today, despite the fact we've still got a strong valuation support from the dividend and the strong balance sheet.
Okay, brilliant. Thanks to it's sharing your insight and how you manage the risk and opportunity there. Michelle, how are we doing on questions?
We've got lots of questions in. Some of the investors might still need convincing, though, about the opportunities for the UK market.
Well, then that's enough for me for now. Why don't you
Brilliant, thank you.
Take on.
We've had lots of questions for you, Alex, but maybe fairly, given this morning's FTSE falls, some investors still aren't convinced. Peter G says, can you provide the economic assumptions you rely on in justifying your optimism for UK growth, especially given some of the inflationary and other issues currently facing the UK? And Keith Mon kind of adds to that, but in maybe a more blunt way, and he says, is the UK not about ripe for another crash?
So I think the most interesting thing is markets. It's difficult to predict market crashes. So again, mostly it's an exogenous event that causes that. So like we saw with COVID, or again the GFC, the sort of excess is either built up or in the case of COVID, a completely exogenous event. So I think again, you need to be careful about trying to time the market, because you don't really know when those exogenous events are going to occur. And again, if you look on investing on a 5-year view, that those events create great opportunities. So if you stay invested or invest more when the market falls, that's exactly what you want to be doing. Staying out of the market in the expectation of a crash, I think, is dangerous. Then in terms of the UK economy specifically, so I've very much got a bottom-up process. So I don't look at the economics very much. I probably spend 5 or 10% of my time there, whereas I spend 90% plus of my time listening to what companies are saying and seeing what kind of shape companies are in. So I definitely take into account what are the general consensus economic views, and we would have our own in-house economist as well to help with that on the margins. But I generally wouldn't invest on any particular economic view. We would take the consensus forecasts. Obviously, the UK is seeing a very strong rebounding growth from COVID today. And then we would think about sort of where are there interesting things and sectors where stocks are doing well. So again, the reason I'm positive on the UK today is about the UK consumer, because the UK consumer is in very good shape, because they've had 5 years where spending has actually been quite depressed compared to other markets. So the US was very much going through a consumption boom pre-COVID. That really wasn't the case in the UK. We had reasonably subdued retail sales, reasonably subdued big ticket purchases, because the consumer was somewhat concerned about what sort of the political and Brexit outcomes were going to mean for those things. And then when we had the big lockdowns, the UK consumer saved very significantly. So that's what gives me the confidence in the UK consumer, that they've got big savings and they haven't been spending for quite a long period of time. So the expenditure that you've seen come through in the consumption area of the UK market, which is by far the biggest part of GDP, I think has further to go and can deal with some of the price rises that we're inevitably seeing because of inflation. So today, you need to be in areas where there is pricing power. You can pass on prices, and when the demand is strong, and particularly if there's shortages, that's where you get pricing power. So I think some really good examples of that would be clearly the motor supply chain has been compromised. So there's a shortage of cars. That actually benefits producers and distributors and sellers of those cars. So Inchcape has got very high margins today. That's also the case in bikes, where I own Halfords. Sort of demand for bikes have gone up because people are increasingly interested in commuting by bike or for health and wellness reasons, but there's a global shortage. So again, as a seller of a product which is short, you can put the prices up to deal with the inflationary increases. And obviously also inflation feeds into wages. So wages in the UK are growing at circa sort of 5% per annum at the moment. So that also, not only have you got strong savings, but your wages are going up too. So the consumption side of things is a very good place to be. clearly on the flip side, if you're an industrial and you're facing those extra costs and you might have low pricing power, that's a risk. So we are conscious across the portfolio to look for companies where we see costs going up. Costs are definitely going up across the board. The question is, can they be passed on? And I think in many cases they can be passed on. Clearly, an area that also benefits from that is financials. The cost base of financials doesn't change that much, but obviously in a higher inflation environment, you generally expect higher interest rates, and interest rates are obviously coming from very low levels. So we do have an exposure to banks and insurance companies that generally benefit from higher interest rates, given just how low the current interest rates are today.
Thank you, Alex. Probably carrying on from what you've just said, Stephen Lee has asked, with the current labour and material shortages in the building sector, do you see a short-term downside in the sector?
So definitely, that's something we've monitored closely, and indeed, it's something where we've benefited from it in terms of buying some of the suppliers to house builders. So initially, we saw that very strong demand, so we bought into the house building space itself. And also, what's great is the larger house builders, the quoted ones, they tend to have the best supply relationships, the longest term contracts with suppliers. So they disproportionately do get product, whereas actually some of the smaller suppliers, some of the smaller house builders, they wouldn't have such long lead times, such big balance sheets, wouldn't be able to prepay on contracts. So it tends to be those that are seeing more the shortages. So actually, you're right. I do think that is restricting the total number of houses being built today. There would be more being built if the materials were more available, but certainly the big quoted builders are disproportionately actually taking market share because they are the best managed and have supply of those goods. Also, buying into some of those goods which are short, I think is a good benefit. So we added Brickability, which unsurprisingly is a brick distributor. That's clearly a product which is very short and is going up in price quite significantly. And actually, as a distributor, you particularly benefit from that because you don't have the extra cost, and gas is a big cost of bricks in terms of production, but you do benefit from the higher selling price because you take a markup on that selling price. We also own Norcross, which do showers and tiles into that supply chain as well. So I think, yes, overall, and there is a shortage, but in terms of the bigger companies, I think we're reasonably well set.
Thank you. So you're obviously sort of tweaking the portfolio with these things in mind. And Andy Shep wants to know, how do you see the fund's sector focus changing over the next 12 months as some of the known key macro challenges wash through?
So again, it tends to be the sector positioning, which you can see on slide 15, is very much an outcome rather than something I sort of say, oh, this sector's attractive, we should add to it here. It's about, as I'm meeting companies, where are the interesting ideas coming up? And then the shape of the fund moves in that way. So it tends to be, where are there cheaper companies, but yet where the fundamentals look good to me, that's where I'll be adding to names. And where things sort of play out or the valuations become higher, that's where I'll be selling. So it's very difficult to sort of say on a 12-month look forward exactly how this is going to look, because it all really depends on both the stock price performance of the current companies we own and also the underlying fundamentals of those companies or the fundamentals of new ideas. So yeah, as I said, as it stands today, we still see good valuations and fundamentals in insurance and specialty retail, and high valuations in staples, metals and mining, capital markets. But if the stocks and fundamentals change over 12 months, we will tilt the portfolio. I would say the average holding period in the fund is about 2 years. So certainly on a 12-month view, there is the possibility that this could change quite a lot.
Thank you. We've got a bit of a style question, really, from Fran Dinshaw. I don't know if I should mention it because it does mention a competitor of ours, but I'm sure after reading Citywire, you do read the FT. And we've got a question. Did you read Robert Armstrong in the FT this morning, distinguishing between value sensitive to growth stocks and value sensitive to rates stocks? It suggests that quality at a fair price is a better bet late in the cycle. Just to get your thoughts on that, please, Alex.
So I haven't read that article. I do read the FT, but given that it's been a reasonably busy day on markets, I haven't read the FT today. I'd say I've always been a value investor. So since I started running money back in 2007, it's always been sort of cheap stocks that the market doesn't understand, but where I think the fundamentals can improve, that are the stocks that really excite me. And that's what I consistently do. So I try not to change my style. I know what works for me and I continue to do that. Obviously, there will be periods where value is out of favor, and that's going to hurt from a stylistic point of view. But I'm willing to sort of ride through those periods because, as I said, periods where the fund's really out of favour generally produce really good upside potential. And obviously, the investment trust structure as well, I particularly like on that front because the times the trust is out of favour and actually there's generally really good buying opportunities, the trust often moves to a discount. So actually, you get a double benefit by being contrarian, investing in an investment trust area. And indeed, personally, this is my largest individual investment, and I generally invest at times when we're at those discounts, so you get very good returns. I think also predicting very big macro trends like are we late cycle, are we early cycle, where are interest rates going to go? That is incredibly tough to do. I think people would have said at any time probably for the last 6 or 7 years that in 12 months times interest rates are going to be higher, and obviously from almost zero rates that makes intuitive sense, but calling the timing I think is really tough. So again, it's all about calling the probabilities, making sure we buy good companies at low valuations, and having a diversified portfolio across lots of sectors that we look at rather than trying to call those big macro themes or change my style.
Thank you. I mean, at the risk of making you call that, I mean, John G is asking, what catalyst do you see for a revaluation of cheap UK stocks, please?
Yeah, so I think given the fundamentals we've seen coming through, I have been surprised actually that we haven't seen better performance of UK equities. So what we have finally in the last sort of 12 months marginally outperformed the US. It really is only a marginal outperformance despite a much lower starting valuation for UK equities. And as we showed on slide 6, actually earnings really starting to come through. So I think for a long time, the UK has been undervalued over the last 5 years, but also for a long time, we've had somewhat soggy fundamentals. So earnings have been okay, but really not great as the UK consumer hasn't been spending, firms haven't been investing. We've sort of been in a sort of 5 year limbo since the Brexit vote on those big picture things. And I think with COVID, you really have seen a jolt, and actually increasingly because COVID and Brexit have sort of been sort of sorted at the same time. Obviously, they're both not completely sorted, but again, the uncertainty and the range of outcomes is now much narrower with both a deal and then the vaccine. I've been surprised that there hasn't been a greater re-rating, and I think that's just generally the reluctance of investors to come back to what is, I guess, globally a reasonably small market. But the fact that hasn't happened, I think that's why there's so much incoming M&A. So while that may not lift the market as a whole, that has certainly lifted a number of stocks in the portfolio. And again, if it continues, which I think it very much will continue, I think could be a further catalyst actually for the market as a whole. Because, as I said, it's not just the valuation being low, but the fundamentals are actually reasonably good in the UK today, which is a combination we haven't seen over the last 5 years.
Thanks, and that brings me on very nicely to our final question from our viewers, Alex. Is another one from Keith Mon. He says, where do you feel the FTSE should be on your figures if we're 25% below the EU and 50% below the US?
Again, that's that's a really difficult question because, again, while I'm very confident on the fundamentals and clearly have a clear view of what I think the stocks in the portfolio are worth, we don't have a view on every single company across the whole FTSE to really make a sort of market call. I suppose I just like to see these in terms of sort of framing the range of outcomes. So again, when I look at a company, I sort of say, how's this company traded over the last 20 years in terms of valuation? Where are we versus history on that range? Are we near the top or at the bottom? If we're at the bottom, that really gives me confidence that in terms of the chance for further derating looks more difficult than the chance of a re-rating back to the average. So again, on the individual stocks, there always has to be a catalyst for why that should happen in terms of what management are doing, changes in the industry, exits of competitors, etc. But on a broad market as well, the makeup of the UK market hasn't changed dramatically versus the Eurozone. So I would say that's the one I would be more confident on, that this big undervaluation that's in line to history should correct over time. Again, how long it takes, or also what form it takes, because I wouldn't rule out a European or US markets falling as part of that, is an open. But I do think that certainly on a relative basis, there's no reason the UK should be trading more cheaply than the Eurozone.
Okay. Brilliant, thanks Alex. Thanks Michelle. Actually, I've just spotted one more a question from a viewer talking about the investment trust, which by the way is trading on nearly on a 4% discount, which is interesting in view of Alex's preference for buying into the investment trust when it's trading a bit cheaply as it is now. But Alex, a question from Hassan Chaduri is really about the concentration within the portfolio. You mentioned he asked, you mentioned holding around 120 companies. Surely that's detrimental to fund performance. If one of these smaller holdings triples in value, the impact on the fund is minimal. So I wonder if you could address that and also talk about how what proportion your top positions make in the portfolio.
Yeah, so the position size is very differential within the fund. So you can sort of see on slide 14 that the top 10 positions do make up a substantial percentage of the assets. But there's two reasons to be in the top 10. First of all, obviously liquidity. Some of these names are big, so you can get those positions very easily. But also, these tend to be larger companies that have more limited downsides. But then also, when you're a bigger company, your ability to totally change the company is much more difficult. So again, for example, sort of Aviva, there's definitely a valuation case there and there's a lot of cash coming back, but Aviva isn't going to totally change. So I think this is a decent, but not an amazing company. So the total absolute upside is also more limited. Some of the smaller names, particularly if they're going through substantial issues, can have much more upside, but also they can have more downside. So I think a good example would be a name called Sylvania Platinum that we've now sold out of. That was a name that looked very attractive. It's a small cap miner in the palladium and platinum space in South Africa. Clearly, there's a lot of political risk there. There's metal price risk, but it was a company with a net cash balance sheet, and also it's not a mine. It's basically a tailings dam processor. So effectively, in terms of mining, it's quite low risk because you're all above ground and it's quite mechanized. That's a company that actually was up over 600% while it was in the fund. So yes, it was a very small 25 basis point position at purchase, reflecting both the fact it was micro cap, so it was sub 100 million when purchased, but also because of its risky jurisdiction and risky business model. But the potential upside more than justified the fact that you might lose half your money in this company. We actually made over 6 times our money. So I think those small 25 basis point positions are there because they're both generally smaller companies, but generally also riskier companies, but with potential for very outsized returns. So indeed, even though that was only a 25 basis point position, it contributed over 1% performance to the fund through 2020. So I think that's why we do some of these very interesting but riskier, smaller positions.
Yeah, okay. 10 bags can make a difference, even if it's a small position. Just on that note, just to end with, you mentioned the average holding of positions is around 2 years. So that implies a sort of 50% portfolio turnover. That makes you very active, doesn't it?
Yeah, so this is a very active strategy. And again, I think you'll see this in value stocks. So again, what we're looking to do is we're looking to buy companies that are undervalued compared to what I think their 3 to 5 year prospects are. And sometimes we'll buy some very high quality companies, but generally we'll buy companies that are on average as good as the market, but aren't valued as good as the market. So the key here is to make sure we identify the change that is happening in these companies and then own the business through that period of change. And then once that change has been recognized and the stock is more fairly valued, we want to move on. So this isn't buying the greatest companies. If you buy companies you think are going to compound on a 10 or 20-year view, clearly you want to hold them for a very long period of time. Here, we're buying companies that on average are average companies, but are traded today much more cheaply than average. And that's where the alpha comes from, holding through that period of change and moving on. So again, I think the fact, one of the reasons there's a limited number of value strategies is to be successful in value in this type of strategy where you're holding through change, you need to own a lot of companies and you need to cover a lot of ground. So if you haven't got a big organization and particularly that analyst team backing you, it's quite difficult to do as a boutique, hence that there's a reasonably limited amount of competition doing this.
Okay, it does sound like it's you've got quite a big job on your hands. Thank you, Alex, for your time and sharing your investment insight. And thanks, Michelle, for moderating the Q&A. And thank you all for watching and sending your questions. Before we go, can I please remind you to complete the feedback survey in the microsite, as we're always keen to improve what we do. With more investment trust programs coming up, so do keep an eye out for those if you found today useful. But yeah, thanks again very much to everyone, and I hope you enjoyed it. And goodbye from all of us, and happy investing.